Well, hi there, everyone. Welcome to Chart This with Dave Keller. Happy Thursday, June 4th, 2026. It is a lovely, not too hot, not too cold, kind of overcast, beautiful June day here in Redmond, Washington. Hope you guys are all doing well wherever you are at. Thanks to those of you tuning in live. We are live streaming on Facebook, LinkedIn, YouTube, and X, and we appreciate you guys tuning in live, those that are able to do so. You have the opportunity to ask questions all along the way and also chat with your fellow Kellerites in the chat and YouTube and elsewhere. If you're watching the show later on our YouTube channel, hey, please use the comment section and drop any questions there. Tomorrow's Friday. That's all mailbag day. So we'll plan an all mailbag episode where we answer some of the great questions we received through the course of this week. Getting plenty of questions these days, given the market uncertainty, or as someone mentioned, an all over the place day in the major averages. I would wholeheartedly agree. I was interviewing JC O'Hara earlier today. JC's a longtime technical analyst at a firm called Roth Capital Partners. He's a fantastic strategist, and we talked just about making sense of this market environment, thinking about multiple timeframes, how to handle these long-term uptrends like we've seen in charts like Sienna and others, which we'll talk about here a little bit later. We sort of, I guess, consoled each other on the all over the place conditions as we were seeing here. Honestly, I would argue no better time to use charts and technical analysis, because what that allows you to do is to define the uptrend in growthy sectors like technology, to recognize a day like today where there's a bit of a shift of sorts as sectors like healthcare just pounding higher, financials pounding higher, a lot of sectors and individual stocks just coming alive today, even as some of the biggest, growthiest names gap down big time after earnings. Let's get into the charts here and see how things played out. Weaker open, stronger close is kind of the name of the day for most of the equity indexes we'll look at here. The S&P 500 opened lower, but quickly pushed higher, almost got to 7,600. Last 15 minutes were a bit of a drop, but overall, pretty good up day logged in by then. The S&P closed around 75.84. That's up 0.4%. The Dow, a sleepy index that we usually follow in name only, but rarely dig into the individual stocks because it's just not a great representation of the market. So the S&P 500, I would argue, is a much better kind of representation of the current market environment. But the Dow, for what it's worth, up 1.7%. When you look at some of the names that were up the most in the Dow, it's charts like Goldman Sachs, showing a lot of strength in the financial sector. The Nasdaq did not finish in the green. It was above the zero level in the afternoon, but did sell off in the last 15 minutes. So basically flat for the day. So I tell you what, for the Nasdaq, this is victory snatched from the jaws of defeat. This looked like a really ugly day out of the open. We talked on yesterday's show about the earnings misses after hours and how names like CrowdStrike and Broadcom and others were gapping down, Micron and others, potentially moving down in complement, and that could create a really ugly day. It ended up creating a really, really ugly open. But I think if you're all bullish here, this should be a really happy day, because what we saw was, even if some of those technology leaders were struggling, a bunch of other stuff started to look really good. And if you look at the day today, a number of sectors actually had a pretty good day, particularly healthcare and financials, which we'll get to in a moment. VIX is continuing to tell you, move on, nothing to see here. VIX back down in a 15 handle, almost got to a 14 handle today. I'd have to look at the multi-year chart to find the last time the VIX got below 15. That's incredibly rare. And the reason why is because, remember, what the VIX calculation is showing you is what daily percent swing the options market is pricing in. That's basically what the number is telling you. And so there's just even in a low volatility environment, even when things aren't moving a lot, there are still subtle movements, because there is buying and selling happening, right? So if trading was closed, the VIX would kind of be zero, right? Because the market would be expecting no change. The market's never expecting no change. There's always just that even little bit of just kind of normal doing business, things kind of changing hands kind of stuff. So that's why the VIX never really gets much below 15, because there's a natural kind of normal volatility. But we're getting down to where the options market is pricing in incredibly low movements. And again, a spike in the VIX would be a big warning sign. Did not see it today. Rates generally moving lower because bonds were moving higher along with stocks. The 10-year yield is back below 4.5%, kind of pushed just slightly above there yesterday. Long bond pulling back below the 5% level as well. Dollar index kind of moving back a little bit. It did move higher through the course of the day. Looking at the commodity side, the crude oil ETF, the USO, had a pretty bad day. So it's kind of classic risk on signaling across the board. So crude oil down, gold and silver higher. We can see the GLD up 0.8%. We talked about the GLD kind of testing that 400 level, testing the 200-day moving average, still holding today. Silver price is holding support as well. Copper price is higher. Natural gas price is higher. But crude oil and gasoline futures all relatively weak. Hey, the good news for Bitcoin is it didn't go down a ton in the last 24 hours. The bad news is it's after it's gone down a ton the last couple of days, or the last couple of weeks have been pretty bad for Bitcoin, and it's accelerated in the last, through the course of this week. Today was more of a choppy digestion day. We haven't talked about those because we haven't a lot of them, but a digestion day, think of it, you have like that big meal, and then you kind of sitting there. It's kind of a digestion. It's not really continuing the trend. It's more just a pause and, wait and see as we build up momentum. And that's what Bitcoin's been doing here for the last 24 hours or so. Currently just trading just below 64,000. This is obviously down from the low 80s not too long ago. So we've seen quite a deterioration in the price of Bitcoin, but holding steady here today. All right, when we look at sectors, you're going to see a pretty good day. And again, we talked yesterday about how, if you made the font size on these labels, the market cap weight of these different sectors, technology would be way bigger than the rest of them. That would kind of be the story. So tech down 1.6%, that hurts. Now, the reason why the indexes are not down big today, the reason why the Nasdaq's not down 2 to 3% is because healthcare was up 3.1%, financials were up 2.6%, real estate up 2.1%. Those three sectors all up over 2%. Now, again, the biggest sector was down a ton, but some of those value-oriented sectors had pretty decent days. And so, again, NASDAQ, to be clear, is not weighted very much in any of those sectors. But the S&P 500, for example, had an okay day. And that's because of the strength that we saw elsewhere. So what's interesting, this is what I was talking about with JC O'Hara earlier today. And that episode should be out to you maybe tomorrow, probably Saturday morning. So keep your eye peeled for that, the latest episode of the Market Misbehavior podcast. But we talked about how what's happened when technology has pulled back during this kind of primary uptrend here in recent months. When technology has pulled back, it's not been like money has rotated out of equities and into other things, into like bonds or something. We're seeing other sectors start to do well, right? So the bear case would be technology starts to sell off. Everyone gets nervous. Everything sells off. Everyone sells out of their equities and goes somewhere else. That's what makes the S&P go down quite a bit. If technology sells off and a bunch of other sectors start to go up, which implies that investors are rotating out of their tech and into other things that have maybe not participated as much, that's what the next big upswing in the bull market could be driven by, right? It's sort of that rotation still within equities, but in another sector. So I think too early to say that exactly is what's happening here, but this is an example of what that could look like. And this is how the market could continue higher and how the uptrend could be in fine shape, even without technology dominating our thinking. Breadth-wise, pretty good day here because, again, everything outside of tech doing generally well. On the New York Composite Index, 70% up to 28% down. On the S&P, 72% up. On the small cap S&P 600 Index, 78% advancers. That small cap breadth has been the strongest. That's the only AD line that's made a new all-time high in May, now into June. And so small cap breadth has been generally better. Today, breadth across the board, pretty good. And so breadth indicators that had been showing some sign of weakness kind of popping up through the course of this week. But man, if you hold Broadcom being down 12.5% probably does not feel particularly good. I would imagine. I don't own Broadcom individually. I don't own a ton of individual names. I mostly use ETFs in my own portfolios, but I analyze a lot of stocks because I have a lot of clients that trade primarily equities. So that's where my attention is often focused as well. So Broadcom down 12.6%. Now, what you have to remember is Broadcom as a chart is still pretty good. We're going to look at that in a little bit. I mean, the primary uptrend, I would argue, is still positive because it's in such a long-term uptrend. It's given back just a small amount of those huge gains that it has experienced up through today. Tesla down slightly, 1.25%. I also asked JC O'Hare about SpaceX's IPO that's coming up. That's set to be next week. I think the end of next week on the 12th. Biggest IPO in history. It's set to be that. It's going to be an interesting one. It should be an interesting day to sort of debrief on what happens. We'll see. On the upside, Alphabet, nice recovery, up 3.7%. NVIDIA, which has been struggling a bit and lagging the other semiconductors, having a good day today as well, up 2%. So NVIDIA is kind of like the anti-semiconductor all of a sudden. I don't know how that happened, but it's definitely happened. Amazon with a good day as well, up 1.5%. All right, we're seeing the live stream go out pretty well here on Facebook, LinkedIn, YouTube, and X. Thanks, those of you tuning in live. Please drop questions or comments as we go. And if you're watching the replay later on our YouTube channel, thanks for watching. Please feel free to like, subscribe, smash the like button, whatever you can do to make it more awesome. That's great. And tell a couple hundred of your friends about the show. That never hurts as well. But thanks, everyone, for watching. And please keep the questions coming. Great to hear from you guys. All right, looking at the heat map, I mean, not a bad day. Again, I mean, yesterday as we're going through these earnings, looking at Broadcom, most likely opening down, and it did, and it stayed down. It finished down 12.5%. And other stocks in the technology sector, obviously having a pretty rough day as well. But if you ignore just that cluster of names, I mean, besides that, it's like the telecom names like AT&T, Verizon, and T-Mobile having a rough time. Other than that, pretty much most things were looking pretty good today, right? And that's what's so fascinating about all the different names and how they are moving. So within technology, obviously not a great day. I mean, it's interesting to note the positive outliers, which would be NVIDIA, Oracle, Cisco, all had good names. Some of the software names like ServiceNow are standing out to me. But other than that, this was a down day for tech. A lot of those charts obviously still pretty constructive, but today a pretty painful day for a lot of those. Again, these charts though are still very constructive. I would say like Micron is still a very good chart. Down 7.7% is not giving back much of the gains. We've still right at $1,000 a share going into the close. Good to see Alphabet finally kind of re-exerting itself. Alphabet's been down for the last week and sort of consolidated for a couple weeks, kind of rotated lower. So a bit of a bounce here today. We'll see if that, turns into something more significant. But within communication services, which again has been one of the worst sectors, if not the worst sector in 2026, I would say the breakdown in a lot of the telecom names, particularly AT&T, pretty bad. AT&T is getting to that so bad it's good thing. I mean, my list of so beaten down, I'm tempted to take a contrarian long position. AT&T and Bitcoin are kind of in that bucket. There are others, but those are the two that kind of stand out to me as, again, from a technical perspective, I would say from a, looking at the trends are bad, but are they getting down to points where the value of what they offer versus the price is compelling? Like they're kind of getting down to that point. All right, outside of technology and outside of communication services, today was all about, I would say, financials and healthcare. Those are two fantastic sectors. The financial sector has been a really interesting one. A lot of these charts are, have been struggling a bit, but a lot of them start to rotate higher. I was looking, earlier this week, we did the stock picking competition with Tom Boley and his team and some others. And, I added Morgan Stanley as part of that paper portfolio. That's looking like a really good chart. Goldman Sachs was the other one. I was kind of going between the two of them. They're both just really, really good. And so those are some of the stronger charts that have been getting stronger. But you also have names like Citigroup that were pulling back quite a bit that are now rotating and making new highs. But I think the really interesting story, and like State Street's another one kind of making new highs here. I think the really interesting story within financials would be things like regional banks, right? Things like Fifth Third that have not had great charts that all of a sudden are starting to break above short-term resistance. Like we're kind of, some of those names like Morgan Stanley, Goldman Sachs have been in long-term uptrends for quite some time. Those look more like technology names, right? I mean, just these nice, consistent uptrends. But something like Fifth Third, has not been a great chart. It's been more sideways, consolidating, more like a coil pattern, but starting to kind of break above the upper boundary there. So the financial sector stands out to me as an area of the market that has not been particularly strong and is starting to show renewed strength. Healthcare is obviously another one. We've had charts like Eli Lilly that have been pretty good, but like United Healthcare, which have been pulling back, popping higher. Merck is actually rotating back toward the upper end of the list. I'm intrigued by some of the biotech names, to be honest with you. This is Amgen. Amgen pulled back to the 200-day moving average right at the beginning of May, has now had 3 bounces off of the 200-day, and today kind of popping above the 50-day moving average for the first time since March. Kind of a nice short-term reversal, pushing above there. A number of other biotech names that stand out to me as I'm going through that list here. Real estate as well. A lot of REITs are not great charts, but there are a number that are starting to kind of sneakily become really compelling charts. And a lot of those have a really decent income component. That's kind of pretty standard in the real estate sector. I mean, REITs often have a lower volatility and a higher dividend component. And a lot of these are starting to show some improving price action. All of a sudden, that means strong price and strong income can be a really powerful combination. So if you've been ignoring REITs, I don't blame you at all. But charts like CCI have been brutal. I mean, just been sleepy, quiet, underperforming charts, and are now all starting to pop up on my new 3-month highs list, which is a list that I review often. All right, I'm going to get to the charts because I have a bunch of them to highlight. I was actually just finishing up. I was trying to get it done before the episode today, but I just couldn't quite get it all done. But I did do a video using the EPS Momentum platform to identify some names sort of outside of technology. Talked about how technology has been dominating, and I used the EPS Momentum platform. That should be on my YouTube channel later today or tomorrow morning. So keep your eye peeled for that. But I've been using EPS Momentum for a little while. If you're looking for stocks that have earnings growth and price momentum behind them, this is a tool you might want to consider. It helps surface companies with accelerating earnings, especially earnings revisions, and also strong institutional buying. And when I said their earnings factor, what's called earnings momentum, is based on earnings estimate revisions, which according to their research, also a number of experts I've talked to in the last 12 months, they all agree it's been one of the most powerful drivers of long-term stock performance. The institutional buying side, they talk about well-documented price momentum factors like average true range, like power days, which is looking at the price volume combination. So we're looking for stocks where the fundamentals and the market action are lining up. If you want to check out their platform, you can go to marketmisbehavior.com/EPS. That'll give you 30% off your first payment on a new account. I would encourage you to check it out. It is a relatively low cost relative to the value you get and the ability to scan for great ideas. And thanks again, my friends at EPS Momentum, for supporting the channel. You can find more info at marketmisbehavior.com/EPS. Daily chart of the S&P 500. I tell you what, out of the open, started to think like this might be one of those big down weeks that was going to get worse and worse. Market just got better. I mean, it got better as the day progressed. I feel like the morning, the weaker open was sort of a shock. That nice improvement, and buyers kind of came in soon after the open. You can see that on a day like today. I think this is where charts are so helpful. The opening tick is like the low of the day. So we opened there and just started drifting higher. So if you kept your eye on the chart of the S&P, you just kind of see it drifting higher through the course of the day. And it pulled back a little bit in the last 15 minutes. But I mean, generally, you just see the improvement through the course of the trading day today. So I would say, good, what ended up being a fairly decent day for the S&P after a really questionable start. And I would say the fact that other stocks outside of semiconductors and software were leading today and improving, I would say, is one of the more encouraging things I've seen here in recent weeks, certainly. This nice day has caused the breadth to continue to improve. We're a little concerned when we approach the 50% level on stocks above their 50-day moving average. That got better in the last couple of days. We're up to around 56%. The long-term breadth has been, I think, no question, still pretty good. It's the short-term breadth that looked a little negative, and the McClellan oscillator dipped below zero this week. I don't know if today was enough to push it back positive, but that's something maybe to watch as well. All right, it's sentiment day. here on Thursday. And so with sentiment, we look at two indicators usually, besides the VIX, which I think of as a sentiment indicator. We look at that every day. On Thursdays, I like to check in on the AAII survey, which is a good measure of individual investors, and then the name exposure index, which is a good survey of money managers. Just helpful to look once a week and just see what's happened there. On the AAII survey, no change in bulls, little less bears. So we're almost a coin flip between bulls and bears. That's actually happened a number of times so far in 2026. You see a handful of weeks where the spread between these two is relatively neutral. I think the only thing I would note here is I get concerned when the market's in an uptrend and we're over 50% bullish, and I'm not seeing that. We're seeing bullish readings in a healthy kind of level. The name exposure index actually wasn't updated on the stock charts platform. This week's reading was down around 86%. So a bit of a pullback. Last week was a really huge swing, and it jumped up to 98%. Anything above 100% to me tells me to be concerned, because that means investors in this survey are leveraged long. Wasn't the case. This week, it actually came back a little bit. So a bit of a lightening up as the S&P was pressing new all-time highs. All right, we feature this chart of the semiconductor index. I just wanted to show why something like the Chandelier exit, which we talked about in our webcast last week, is so valuable, right? So the SMH, obviously in a good uptrend. Today was a shot, like kind of a shock, right? It was a crazy day, weaker open, nice improvement. We're still not touching that Chandelier exit, which is based on average true range. That's kind of what you want. You want a trailing stop that follows the trend higher in an uptrend, that's close enough to get you out early before you lose your shirt, but not so close that it triggers every time there's a down day. So I thought it was important to just note we've had some pullbacks since the end of March, but none of them have really hit that what's called the Chandelier exit system. If you're not familiar with that, we covered that on my webcast recently. You can find more info on stock charts. They have some good articles talking about the Chandelier exit. And I've done some videos for Stock Charts TV that go through some examples of that, I think, as well. All right, so here's the damage on Broadcom, right? From a technical perspective, what we talked about was, all right, it's gapping lower in the after hours. Will it hold support? So it did get below the 21-day EMA, but it held that level. Remember we talked yesterday about 400, 405, like that, the swing lows from May? We literally held that all day today. So I would say that on the surface is a pretty encouraging sign. I think below that, below the 50-day, below 400, this is a pretty tough chart. So for now, obviously a big down day, but I mean, it's still holding the May low. So I think that's still okay. CrowdStrike, I mean, hit the Chandelier exit, but didn't close below it, held above the 21-day EMA. I mean, that's how much these names can give back recent gains and still be within a clear primary uptrend. I don't see anything to really be concerned about on that chart just yet. What you have to be concerned about, and we're looking at Sienna now, which is another technology name. This is a telecom equipment name. This has been in such a strong, consistent uptrend, right? Higher highs, higher lows. Look how long it's been since the RSI has been below 40. You have to go back to April of 2025 for the last time the RSI was, I mean, much below 50, but above 40 consistently since the beginning of April of last year. So for over a year, the momentum's been strong. The trend's been strong. It's been above the 50-day that entire time. Traded below the 50-day, but closed back above it. So on this kind of chart, holding the 50-day on a closing basis, RSI remaining above 40, that would tell me that this kind of thing is still going okay. Anything below that, so we're kind of right at that point where I think this may start to change, but Sienna for now still okay. Palantir, and I know a lot of people got excited last week with this big move higher. On that move, I sort of looked to the left and said, all right, we get above the 200-day and get above these March highs, I'll start to get excited too. Never happened. We kind of traded right up to there and came back. We highlighted earlier this week, that's the evening star candle pattern. We have a big up day, a little day, and then a big down day. And that, of course, has led to further deterioration. So I would say the resurgence of Palantir may be premature for me getting above the 200-day and getting above these March swing highs. I think the stock above 160 is a pretty interesting chart. But until then, this is a sideways trend at best, in my opinion. There are some things that are starting to work. Healthcare, of course, had a fantastic day today. Eli Lilly, which has pulled back a little bit. Again, still above the 21-day EMA, still strong price, still strong momentum. I think this is a good chart until proven otherwise. I like the upward swing. Want to see it get above those swing highs around 1120 and hold them. Ben is Franklin Resources. It did close below the 21-day EMA yesterday, but today right back in the driver's seat, pushing back higher. So this is what happening in a lot of the healthcare and financial stocks. Pulling back to moving average support, holding the support, and now rotating higher. That could be, the next big uptrend could certainly be supported by these sorts of sectors and these sorts of names. Ben, by the way, with a 4+% dividend yield on a chart that's going up, that's pretty powerful. Back within the healthcare sector, I want to highlight AbbVie. I mean, I mentioned earlier some of the, when I think about the dominance of growth, I'm looking at some of the value sectors and finding some of those just emerging names. I often scan for stocks making new 3-month highs. I also look for stocks that have been below the 200-day moving average that are just starting to pop up. And AbbVie came to my attention, breaking out above the 200-day finally, RSI pushing above 60. I think that's a good upside rotation and a name that really hasn't been a great chart. And that breakdown of the 200-day was a problem. But look at the big bullish engulfing pattern, the gap, the pullback, and now we're resuming the uptrend. So it's kind of checked all the boxes, finally regaining its footing, putting in some higher lows, momentum improving. All right, let's take a question or two, shall we? Boy, I am seeing a bunch of, this whole side conversation here about cash in your accounts. And I'm not going to put anyone's name up here, but this is I will make a comment on this. So again, my goal is to never make any recommendations or tell you what to do with your cash or with your portfolio. I think that's your decision. My goal is not to make your decision for you, but to try to give you the tools and techniques you need to make better decisions of your own. That's my goal. But I will tell you that is a known issue, what they call a sweep account with a lot of brokerages, and Schwab is most notable for this. They default to a sweep account. Sweep account is you put money in your account, they kind of sweep it into an account, right? Like sort of a holding tank, a cash or money market account until you're ready to deploy it into something else. Schwab is famous for putting you in a non-interest bearing accounts. They put you in something that gets no interest. It's super annoying on other platforms like Fidelity, which is one that I use. You can pick what account you want. You can make sure that it's in an interest-bearing account, but not all platforms allow you to do that. And Schwab is, I would argue, unfortunately, one that does not do that well. And so you have to manually go in if you want to put it in something and literally put it into some sort of ETF that pays, or some fund that pays some sort of money market type of rate. But thanks for highlighting that, those of you talking about where you're parking your cash. Not that that's something you should do, but I would say certainly wherever you put your account, look for where they automatically put your cash. And I bet there's a better option you can find. And either they can do it automatically for you, or they'll fight you on it, and you can just manually rotate things anytime you want to put something in an interest-bearing account. That would be my thought along that. There's another question earlier that I saw. Sorry, I meant to grab this and then I totally missed it. Oh, yeah. Yeah, no, 3P investor. Thanks for mentioning this. Yeah, so it's so interesting. We did this stock picking competition earlier this week. We all had to pick a team with 10 stocks, and it's on my. This is the paper that I use. By the way, not that my process is perfect. I go big time pencil and paper for things like this, and I did that. I don't do fantasy football. It was just way too much time and attention and dealing with injuries. I used to do it a lot earlier in my career, and we'd have these cannot tell you how important it was, this fantasy football back in the day. But my papers, I would have scratches like this all over the place. So I literally have a paper and I start drawing ideas and I start circling things or underlying things. That's how I did it. So I'm trying to take all of that and put it in a digestible format for my premium members to try to track some of those movements. But I appreciate you noting that. I mean, a lot of things, it's going to be interesting. We had sort of this initial move from the moment we did that competition. There's been quite a lot of fluctuation, of course, in the markets. But what's so interesting, like today, is it's the non-technology stuff that's starting to look so interesting, and very few of it. None of us picked a semiconductor stock. I mean, some of us picked more technology than others, but not a ton. And so it'll be interesting to see how things actually start to play out from there. I saw a couple of comments on the Hindenburg Omen, and yeah, I did. Please go back to yesterday's episode. That was on Wednesday, June 3rd. I also dropped an article in the stock charts platform earlier today, and I don't know if that's loaded just yet, but check that out. The Hindenburg Omen, of course, is a broad market indicator. It did get its second confirmed signal this week, and so what that means is that the Hindenburg Omen is telling us we are showing conditions very similar to previous market tops. And as I mentioned yesterday, and again, go watch that episode for more details on it. But, I think of the Hindenburg Omen as a warning sign. It is an alarm that is going off. And what you do when the alarm goes off is up to you, right? When you hear the tornado siren, are you just ignoring it and assuming it's fine? Or are you going down in the basement and grabbing the food and the water and the flashlight and the ham radio or whatever you have, and just, recognizing that things could get a lot worse? Like, that's what's happening right now. Those alarm signs are going off. The Titanic syndrome fired last week, the Hindenburg Omen now confirming this week. Now, is it a great timing tool? Not often, right? And what I would tell you is, even on times when the Hindenburg Omen, I would argue, has worked remarkably well, the market's has kept going higher for weeks, if not months, before the eventual peak emerges, right? So you have to remember, it's not a trend following indicator. It's an indicator anticipating tops. This is where we want to look at spreads, volatility, defensive sectors, all those things. None of those warning signs have happened yet. So we'll keep a watchful eye, and we'll certainly keep you updated. Folks, that'll do it for today. Thank you so much for watching the show. Thanks for tuning in, those of you doing it live. If you're watching the show later on our YouTube channel, hey, I appreciate you tuning in as well. Drop a question in the comment section on our YouTube channel. Maybe we'll feature it on Friday's All Mailbag episode. In the meantime, have a wonderful evening. Be well, stay safe, and remember, it's always a good time to own good charts. Take care, folks.